Welcome to the Prime Property Finance Podcast with Gareth Morgan and Mark Watts. This unique podcast will dive deep into all areas of property investing finance, going behind the scenes with property professionals, investors and clients. Between us, we have 35 plus years experience in property finance. The podcast has been launched to share knowledge, mindset requirements and experiences of successful investors and professionals. We aim to simplify many of the complicated areas of finance and investing and provide valuable and easy to implement tips. Keep an eye out for our new longer episodes every Tuesday and our shorter ones every Friday. 10 mortgage terms you should know before you buy or refinance. The aim is to avoid confusion, make smarter decisions and speak the lender's language. In this episode, we're going to dive into some key mortgage terms and list those out and give a little bit of an explanation so that next time you are looking for a mortgage, it'll be a lot easier for you to understand the process and what's involved. Before I do that, I just want to give you a quick update on what's been going on in my personal life. At the end of 2022, I had a busy period where I moved house, moved office and moved business, all within a space of a week, which was a bit of a headache at the time, but it was a great memories looking back. It's been really exciting growing the business over the last 12 to 24 months. But at the same time, it's been really challenging over the last 12 months because we've been doing out our family home. So we've been doing a full renovation on our family home and we're on the verge of moving back in and, you know, it's going to be our dream family home and we're super excited to get in there and settle back down as a family again. So really excited for that. So anyway, let's dive right in. 10 key mortgage terms. Number 1, agreement in principle. So this is an AIP, also known as decision in principle, which is DIP or DIP, also known as mortgage in principle, MIP. So you got AIP, DIP, MIP, all meaning the same thing. So ultimately, this is a lender's early indication of whether they might lend to you. What we do is we put in your basic information into the lender's system. They do a soft credit check. We tell them what your income is. We tell them what your outgoings are, how much you're looking to borrow, your circumstances. And they will, based on the information provided, give us an early indication of whether they will lend or not. Most people need these when you're dealing with an estate agent and you're looking to make an offer on a property, or even in this day and age wanting to view a property. Agents will want to see that you've already spoken to a broker or a mortgage lender and that you have an agreement in principle so that you're not wasting their time, the seller's time, or obviously your own time. So getting an agreement in principle at an early stage makes the whole process a lot easier to move on with a mortgage application. Number 2, loan to value or LTV. So this is a really important one when it comes to lending. It's the loan to value is the percentage of the loan you are borrowing against the value of the property. So if you're buying a property at 100,000 and the loan is 90,000, that's a 90% loan to value. So you're putting in 10% deposit and you're borrowing 90%, which is 90,000. So in that example, that's quite a high loan to value, and the lower the loan to value generally means better rates. So as you move down in the percentages, the brackets, so if you move from 90 to 85%, you'll get a slightly better rate. If you move from 85 down to 80 or 75, then you'll get better rates. And usually it ends out around about the 65 to 60% is where you'll get the best deals. You don't usually get much of a better deal dropping below 60% loan to value. So the more equity you have, or the bigger the deposit, the better your loan to value ratio, and effectively the better the rate you'll get. Number 3, fixed rate versus variable rate. Fixed rate, pretty straightforward. It does what it says on the tin. Means your rate will stay the same for that period. So the rate might be fixed at 4.5% for 2 years, 3 years, 5 years, 10 years, whatever it is the length of that fixed rate period. The alternative that is a variable rate, most commonly seen in 2 different forms, either as a base rate tracker, which tracks the Bank of England base rate, or a variable rate tracker, which is a standard variable rate of the current bank that you're applying to. So a couple of different rates. One moves up and down in line with the Bank of England or similar to the Bank of England. So that's got the ability to move up or down with the economy, or the fixed rate, it stays the same regardless. Point 4, SVR, which is a standard variable rate. I just touched upon it in the previous one, but every single bank has their own standard variable rate. And what that usually means is if you come off a fixed rate mortgage, if you don't get a new fixed rate or you don't change to another lender, you'll revert onto their default rate, which is their standard variable rate. And this is usually higher than what you've already been on, or if you shopped around, what you could get elsewhere. So if you are on a standard variable rate, unless you are looking to move home or looking to sell or have any specific reason why you'd stay on that and you don't want to tie into a new deal, then you would stay on the SVR, the standard variable rate. If you don't want to stay on it, then shop around, because the likelihood is you will be able to get a better deal. Number 5, product fee or arrangement fee. This has been quite a high topic of conversation of late, especially on the buy-to-let side, not so much on the residential side. But basically, this is the cost, the upfront cost that lenders charge for a mortgage product. So they have a valuation fee, which it goes to the valuer to go out and value the property. But the lender arrangement fee is a fee that they charge in order to arrange the mortgage. And you can pay this upfront, or in some instances, you can add it to the mortgage, but you will pay interest on that over the long term if you do add it to the mortgage. What the benefits are is paying a higher fee will sometimes get you a lower rate, or it should get you a lower rate. So on a residential mortgage, on a repayment, this does vary from time to time, but if you are around the £200,000 mark, it's usually better to pay a fee and get a lower rate than it is vice versa. It does on low mortgages. It very rarely pays to pay a fee. It's best to have a deal with no fee and a higher rate. But each circumstance is on its own, and it's very difficult to predict that definitely. So if you want to look into that a little bit more, then we can always look at those options for you. Number 6, early repayment charges, ERCs. So if you tie in with a lender for a 5-year fixed, for instance, they are guaranteeing you the rate for the next 5 years. So it's easy for you to budget, and you know that whether the market goes up or down, that you're going to be paying the same rate and the same payment for the next 5 years. Now, there's a risk to the lender there that if the rate goes down, it's costing them money. Whereas if the rate goes up, they're making money. So on that basis, if you want to get out of a deal, then the lender has fixed in the rate. They've had to pay for that source of the tranche of funds from wherever they get it from, whether it's from savers or from elsewhere. But they have to make that cost adjustment as part of their overall strategy and their long-term forecasts. So if you want to get out of the deal, you have to pay to get out of it, because, like I said, there's a risk to the bank. So and there's a cost to actually setting up the thing in the first place. There's a lot of admin and internal admin that goes through setting up a mortgage, a lot of paperwork, a lot of people involved in the process. So if you want to leave, then you have to pay to leave. In some cases, we have had people pay early repayment charges because when the rates came down from 5-6% back in 2008, 2009, and they came down to 0.5%, people were paying the early repayment charges because they could get such a better deal. When there's not huge amounts of changes in the market, then there's often not much purpose or point in doing so. The other reason you may do is if you're selling your property and you have to get out, then you will have to pay that charge. Also, some lenders do have, if you are just selling your property and not buying one, then some lenders do have a deal where they won't charge you that, but there's not many that will give that as a benefit. Number 7, porting your mortgage. So porting your mortgage is where you take, if you're moving home, you take the current mortgage that you've got on your existing property and you move it over to the new property. Why would you do that? Well, you may be on a low rate that you don't want to get rid of, so you want to take that with you. Also, you may not want to pay the early repayment charge. So if there is an early repayment charge, generally the lender will let you transfer this mortgage onto the new property so that you don't have to pay it. Not all lenders allow porting, and it is a new application process, but usually means you can keep the deal that you've got and not have to pay an early repayment charge. Number 8, capital repayment versus interest only. So generally on a residential mortgage, most mortgages are done on a capital repayment basis, which means you are repaying the mortgage over the term of the mortgage. So if you have a 20-year term, by the end of year 20, you won't have anything left to pay. If you have an interest-only mortgage over a 20-year period, you will only be paying the interest on the loan and not paying back the loan at all for the next 20 years. So if whatever you started out with will still be left at year 20. On buy-to-let, what we see is most of the mortgages are based on interest only and not capital repayment. You can do both, but investors like to have interest only so that over time inflation pays down the value of the loan, and also they are making a difference between the rental payment and the interest only and using that as income or saving that up as a deposit to purchase another property. Number 9, underwriting. So this is what goes on behind the scenes. So when we submit a mortgage application to a lender, the lender will go through all of the information that we've provided. They'll go through your income, they'll go through your outgoings, your credit history, and all your documents to check that, one, what we've inputted on the application is correct. And by looking through your bank statements and your pay slips and your credit report, we'll verify all of that income is correct to see if it matches their criteria. And also they'll go through the valuation report to check that that meets their criteria. And once they've done all of the underwriting and checked the valuation, then they will provide a mortgage offer. Now, underwriting, clients sometimes argue with underwriters that things aren't fair and it doesn't make sense. Ultimately, it's each lender's own prerogative on whether they want to lend you money or not. And some people think that they ask for too much information. But if a friend of yours asked you to borrow £500, the first thing you do is ask them, what do you want the money for? And how are you going to repay? And how do I know you're going to repay? And where can I trust that you're going to repay? So if you want to borrow 500,000 from a lender, they are definitely going to do the same thing and looking into it in a lot more detail. So that's the understanding for it. And finally, we have number 10 is affordability assessment. So this is an addition to underwriting or part of the underwriting process. So the affordability assessment is how lenders decide how much you can borrow based on your income, your expenses, and your lifestyle. It's not just your salary. So if you can imagine a single person earning £50,000 a year with no debts, no credit commitments, and just a simple lifestyle, and then you had a family of 5 with a joint income of 50,000, 3 children under the age of 10, 2 car loans, and a couple of credit cards, the exact same income, if they were to assess the affordability on income only, then you'd get the same outcome. But when you look at the expenses and the lifestyle and the wider picture, you can see that the single person with 50k of income with no expenses and no children will be able to borrow far more and afford far more than a family of 5 that with 5 mouths to feed and clothe, and also the expenses going out for the cars and credit cards. So it's the overall assessment of your affordability for the loan that you're asking for. So hopefully that's been helpful. That's just 10 top key mortgage terms for when you're looking to apply for a mortgage, or if you're looking to apply for a refinance, understanding what they mean and a little bit more about why they mean what they mean. And if you've got any questions or any comments or tips, or if you'd like us to cover anything specific on the podcast, then please get in touch and we'll be happy to do so. See you on the next podcast. Thank you. Thank you so much for listening to our podcast. We hope you have learned something and have some tips to take away. We'd be very grateful if you enjoyed the show. You could give us a review and share with anyone that you know that may be interested. And of course, subscribe to the show so you can get notified when a new episode is released. If you'd like us to answer any questions or go deeper on a specific topic, please drop us a message at primeproperty.finance. See you on the next episode.